Imagine you sign a contract today to deliver something over the next 20 years. You have not delivered anything yet. You have not collected a single dollar. But you sit down, you estimate what that contract might earn across all 20 years, and you record that entire imagined total as profit now, this year, on today's income statement. That sounds like it should be illegal. It was not. For a company called Enron, it was an approved, audited, regulator-permitted accounting method. And it was the engine of one of the largest corporate collapses in history. A company that went from being the 7th largest in America, a Wall Street darling for 6 straight years, to bankruptcy in under 2 months. This is Market Cap Stories. Today, how Enron learned to book the future, and what happened when the future finally arrived. Enron did not begin as a fraud. It began as something quite ordinary. In the mid-1980s, Enron was formed from the merger of 2 natural gas pipeline companies. Its original business was physical, tangible, and easy to understand. It owned pipelines. It moved natural gas from one place to another. That is a real business, a solid, if unglamorous, infrastructure business. But the leadership of Enron was ambitious, and they came to see the pipeline business as too slow, too dull, too limited. The most important figure in this shift was a man named Jeffrey Skilling, who joined Enron from a consulting background and rose to become its chief executive. Skilling had a vision for what Enron could become, and the vision was a radical departure from pipelines. Skilling wanted Enron to stop thinking of itself as a company that owned physical things. He wanted it to become a kind of financial trader, a company that bought and sold contracts. Specifically, Enron would create a market in energy itself. It would sign contracts to buy gas and electricity, and contracts to sell gas and electricity, and it would profit from sitting in the middle, from being the trading desk for energy. Now, trading energy contracts is not, in itself, illegitimate. Real businesses do it. But notice what the shift does to the company's nature. A pipeline is a physical asset. You can see it. You can measure the gas flowing through it. Its value is grounded in something real. A 20-year contract to deliver energy is something else. Its value depends on estimates of future prices, future demand, future costs. It is a promise about the future. And a promise about the future is a far softer, far more flexible thing to put a number on than a steel pipe. This brings us to the central mechanism of the entire Enron story. It is an accounting method called mark-to-market. I'm going to explain it carefully, because if you understand this one idea, you understand how Enron worked and how it failed. First, the ordinary way of accounting for things, sometimes called historical cost accounting. Under the ordinary method, you record revenue when you actually earn it. You deliver a product, you provide a service, money changes hands or is genuinely owed. You record that real, completed transaction. The income statement, under that method, is a record of things that have actually happened. Mark-to-market works on a different principle. Under mark-to-market accounting, you record the value of an asset or a contract based on its estimated current market value, right now, even if no transaction has occurred. For some assets, this is perfectly sensible. If you own a stock that is traded on a public exchange every day, its market value is genuinely knowable. It is right there on the screen. Marking that to its market price is reasonable and accurate. But here is the problem, and it is the whole problem. What is the market value of a 20-year contract to deliver energy to a customer. There is no exchange where such a contract trades every day. There is no screen showing its price. So to market, someone has to estimate it. Someone inside the company has to build a model, a forecast of energy prices, demand, and costs, stretching out across 2 decades. And from that model, produce a single number, the supposed present value of all that future profit. Enron received permission from regulators to use mark-to-market accounting for its energy trading business. And the consequence was profound. When Enron signed a long-term energy contract, it did not wait 20 years to record the profit as the energy was delivered. Instead, it estimated the total profit the contract might generate over its entire life and recorded a large portion of that estimate as income immediately in the year the contract was signed. Let me now draw out exactly why this practice is so dangerous. Because the danger is not obvious at first. And that is precisely what makes it dangerous. Consider the first problem. The estimate is made by the company itself. The number that becomes Enron's reported profit is not handed down by an independent market. It is produced inside Enron, by Enron's own people, using Enron's own assumptions about a future that nobody can actually know. And those same people are under enormous pressure to deliver growing profits every quarter. So consider the incentive. If you want this year's profit to look bigger, you simply make your assumptions about the future more optimistic. Assume energy prices will be higher. Assume demand will be stronger. Assume costs will be lower. A more hopeful forecast produces a bigger number, and that bigger number becomes reported profit today. Now, the second problem, and it is even more serious. Once you have recorded that estimated future profit as income today, you have used it up. You cannot record it again. So next year, to show growth, and a company like Enron absolutely had to show growth, you need new profit. But last year's contracts have already been fully counted. So you must sign new contracts, bigger contracts, more contracts, and book their imagined future profit too. And the year after that, you need even more. The company is forced onto a treadmill. Each year, it must book more future profit than the last, simply to stand still. And here is the third problem, the one that ties directly to collapse. Reported profit under mark-to-market is not cash. Enron could report $1 billion of profit from a contract and not have received anywhere near $1 billion of actual money. The profit was an accounting entry, a number derived from a forecast. The cash, if it ever came at all, would trickle in slowly over many years. So a gap opens up, a gap between the profit Enron reported and the cash Enron actually held. And every year, that gap grew wider. This gap is the quiet heart of the whole story. On paper, in its reported earnings, Enron looked enormously profitable. In reality, in actual cash, it was burning money, spending heavily, investing in grand projects, and not generating anything like the cash that its reported profits implied. A company can survive looking less profitable than it is. A company cannot survive for long reporting profits it is not turning into cash. So Enron had a growing problem. Its reported profits were not turning into cash. And worse, many of its actual ventures, its real-world investments in power plants and broadband and overseas projects, were performing badly. They were producing real losses and real debt. If those losses and debts appeared on Enron's main financial statements, the picture would darken fast. The growth story would break. Enron's solution to this is the second great mechanism of the story. It is the use of what were called special purpose entities, though it is easier to just call them off-the-books partnerships. Here is the idea in plain terms. Enron created a large number of separate legal entities, partnerships, and companies that were, on paper, distinct from Enron itself. And then Enron would move its problems into them: a failing investment, a pile of debt, an asset that had lost value. Enron would transfer it into one of these separate entities. Because the entity was legally separate, its debts and its losses did not appear in full on Enron's own balance sheet. To anyone reading Enron's main financial statements, the problem had simply vanished. Now, there is a crucial detail here, and it is what turns aggressive accounting into something far worse. For these separate entities to be treated legitimately, as genuinely independent of Enron, accounting rules required that they be backed by real, independent outside investment. They were supposed to be truly separate, with their own outside owners genuinely at risk. But in many cases, the reality was different. Some of these entities were not truly independent at all. They were effectively controlled by Enron. In certain cases, they were even run by Enron's own chief financial officer, Andrew Fastow, who arranged for himself to personally profit from them. So consider what this combination actually produced. On one side, mark-to-market accounting let Enron report optimistic, estimate-based profits today. On the other side, the off-the-books partnerships let Enron hide its real losses and its real debt away from view. One mechanism inflated the good news, the other concealed the bad news. Together, they allowed Enron to present for years a picture of itself that was increasingly, dangerously detached from the cash reality of the business. At this point, a reasonable person asks an obvious question. Where were the watchdogs? A large public company does not operate in the dark. It is surrounded by people whose specific job is to check it, to verify that the numbers are honest. So how did this continue for years? The answer involves several groups of watchdogs, and a common thread runs through all of them. The thread is conflict of interest. Consider, first, the auditors. A public company hires an independent accounting firm to audit its books, to examine the numbers and certify that they are accurate. Enron's auditor was a major, respected accounting firm. But here is the structural problem. The auditor was paid by Enron. And the auditor did not only audit Enron, it also earned very large fees from Enron for consulting work. Separate, lucrative business. Sit with that conflict. The firm responsible for telling the public whether Enron's numbers could be trusted was financially dependent on keeping Enron happy as a client. An auditor who challenges a client too hard risks losing not just the audit fee, but the far larger consulting fees. That does not mean every judgment was corrupt, but it means the incentive to look away, to accept an aggressive interpretation, to not make trouble. That incentive was real, and it was powerful. The same pattern of conflicted incentives appeared elsewhere. Wall Street investment banks earned substantial fees from doing business with Enron, which gave them reason to stay positive on the company. Many stock analysts who covered Enron worked for those same banks, and they kept positive ratings on the stock far longer than the deteriorating reality justified. In the company's board of directors, the body meant to oversee management, approved arrangements, including the conflicts around the off-the-books partnerships that a more skeptical board might have refused. So the picture that emerges is not really a picture of one or two villains. It is a picture of a whole system of supposed checks, auditors, banks, analysts, the board, in which nearly every party had some financial reason to keep the Enron story alive, and very little reason to be the one who broke it. The watchdogs were there. They were simply being fed by the thing they were supposed to watch. A gap between reported profit and real cash can be hidden for a while. It cannot be hidden forever. Sooner or later, a company has to pay real bills with real money, and accounting entries do not pay bills. Through 2001, pressure built. Some observers, a small number of skeptical journalists and analysts, had begun asking pointed questions. The simplest and most damaging question was this: if Enron is as profitable as it claims, where is the cash? Why does a company reporting such enormous earnings keep needing to raise more money? Why is its cash flow so weak compared to its profits? In the second half of 2001, the structure began to come apart. Jeffrey Skilling, the chief executive who had driven the transformation, resigned suddenly after only months in the top job, a departure that alarmed the market. Then Enron was forced to disclose a series of problems. It announced a large loss. It revealed a significant reduction in shareholder equity. And, critically, it began to admit problems connected to the off-the-books partnerships. Once the partnerships came into public view, the unraveling accelerated. Enron was forced to restate its earnings, to go back and admit that profits it had previously reported had not been real. Restated earnings are, for a public company, a profound signal of danger. They tell the market that the official numbers, the audited numbers, the numbers everyone had trusted could not be relied upon. What followed was a collapse of trust. And trust, for a company like Enron, was everything. Enron's credit rating was cut. A lower credit rating meant Enron had to put up more cash to back its trading operations. Cash it did not have. Trading partners, now frightened, stopped doing business with it. The trading operation, the supposed core of the modern Enron, seized up. A rival company briefly explored buying Enron, then walked away once it looked closely at the books. In December of 2001, Enron filed for bankruptcy. At the time, it was one of the largest corporate bankruptcies in American history. The company had gone from a market value in the tens of billions to bankruptcy in a matter of weeks. The collapse of Enron did not end only with Enron. Its consequences spread outward. The accounting firm that had audited Enron, one of the largest and most established in the world, did not survive the scandal. Its reputation was destroyed, and the firm effectively collapsed, taking with it the jobs of many thousands of employees who had nothing to do with Enron. Enron's own employees were hit especially hard. Many of them had been encouraged to hold their retirement savings in Enron stock. When the stock collapsed to nearly nothing, their savings collapsed with it. People who had worked for the company for decades lost both their jobs and their retirement in the same season. There were legal consequences for the leadership. Senior figures at Enron faced criminal prosecution. Jeffrey Skilling was convicted and sentenced to a long prison term. Andrew Fastow, the chief financial officer behind the partnerships, cooperated with prosecutors and also served prison time. Kenneth Lay, the company's chairman, was also convicted, though he died before sentencing. And the scandal drove a significant change in the law. In its aftermath, major new regulation was passed to tighten the rules on corporate accounting, on auditor independence, and on the responsibility of senior executives for the accuracy of their company's financial statements. So what is the durable lesson here? The part worth carrying into the next case. The lesson is not simply Enron committed fraud. That is true, but it is the ending, not the lesson. The deeper lesson is about the difference between two things that look alike on a page, but are not alike at all. Reported profit and actual cash. Reported profit is to some degree a matter of judgment. It depends on accounting methods, on estimates, on assumptions about the future. It can be honestly arrived at, or it can be aggressively shaped. Cash is harder to fake. Cash either arrived or it did not. It is in the account or it is not. So the transferable habit is this. When you look at a company reporting impressive profits, do not stop at the profit line. Look for the cash. Ask whether the reported earnings are actually turning into real money flowing into the business. If a company reports growing profits year after year, but never seems to generate the cash to match, if it must constantly raise money from outside just to keep going, then the profit and the reality have come apart. And when profit and reality come apart, it is only a question of time before reality wins. Enron reported billions in profit right up toward the end. On paper, it was one of the most successful companies in the country. But the profit was a forecast, and the forecast was a story, and the story was running further and further ahead of the cash. When the two finally met, there was almost nothing underneath. In a market full of companies presenting their best possible numbers, the most valuable habit an investor can build is to ask of every impressive profit, where is the cash? Read past the headline. Follow the money that actually moved. If this is the kind of strategic anatomy you find useful, subscribe to Market Cap Stories. We will see you in the next case.